September 15, 2008. Wall Street's fourth largest investment bank collapsed in a single day. $639 billion vanished, not from war, not from natural disaster, but from a financial system that had been secretly rigged to fail. And here's what should terrify you about Lehman Brothers. This wasn't an accident. This was the inevitable result of decisions made by bankers who knew exactly what they were building. A house of cards so massive, so interconnected, that when it fell, it nearly took the entire global economy with it. But here's the part they don't want you to understand. Lehman didn't fail because of bad luck or market forces. They failed because they perfected a system where profits were private, but losses were public. Where risk was hidden until it exploded. Where the people making the decisions never faced the consequences. And once you see how they built this machine, how they operated it for decades, and why it was designed to implode, you'll understand that 2008 wasn't a crisis. It was a preview. Because the same mechanisms that destroyed Lehman are still running today, bigger and more dangerous than ever. This is the story of how one bank became too big to fail, too interconnected to save, and too corrupt to survive. But more importantly, this is the blueprint for understanding how modern finance actually works. Not the version they teach in business school, but the version that creates billionaires while destroying entire economies. Let me show you the three phases of Lehman's rise and fall, the specific decisions that guaranteed their destruction, and why every lesson we were supposed to learn has been systematically ignored. Before we dive into the collapse, you need to understand what Lehman Brothers actually was. Not just an investment bank, but a financial empire that had survived the Civil War, 2 world wars, and the Great Depression. Founded in 1850 by 3 German immigrant brothers who started as cotton traders in Alabama, Lehman had evolved into one of Wall Street's most prestigious institutions. By 2007, they employed over 26,000 people across the globe. They managed assets worth $600 billion. They were the 4th largest investment bank in America. But here's what made Lehman different from traditional banks. They didn't just take deposits and make loans. They were what's called a bulge bracket investment bank. They underwrote massive corporate bond offerings. They managed initial public offerings for the world's biggest companies. They traded currencies, commodities, and derivatives worth trillions. Most importantly, they used something called leverage to amplify every bet they made. Here's how leverage works in simple terms. If you have $1 and you want to buy $10 worth of stock, you borrow $9 from someone else. If the stock goes up 10%, you make $1 profit on your $1 investment. That's a 100% return. But if the stock goes down 10%, you lose your entire dollar, plus you still owe $9. Leverage amplifies gains, but it also amplifies losses catastrophically. Lehman Brothers was leveraged 30 to 1. For every dollar they actually owned, they had borrowed $30 to make bigger bets. This meant that if their investments dropped just 3%, they would lose everything. But it also meant that small gains generated massive profits. And for years, this strategy made Lehman billions. The transformation began in the late 1990s under CEO Dick Fuld. Fuld had joined Lehman in 1969 as a commercial paper trader. He was known for his aggressive style, his loyalty to the firm, and his absolute belief that Lehman could compete with anyone on Wall Street. Under his leadership, Lehman shifted from traditional investment banking into something far more profitable and infinitely more dangerous: real estate. Here's the timeline that matters. In 1994, the federal government passed the Community Reinvestment Act modifications that encouraged banks to lend to lower-income borrowers. The idea was noble. Increase home ownership, especially among minorities and working-class families who had been excluded from traditional mortgages. But the execution created a massive opportunity for investment banks like Lehman. Traditional mortgages worked simply. You apply for a loan from your local bank. The bank checks your income, your credit, your down payment. If you qualify, they lend you money and you pay them back over 30 years. The bank keeps the loan on their books and collects interest. If you default, the bank loses money. So they're very careful about who they lend to. But Lehman pioneered something called the originate to distribute model. Here's how it worked. Local mortgage brokers would originate loans, meaning they'd find borrowers and create the paperwork. But instead of keeping those loans, they'd immediately sell them to investment banks like Lehman. Lehman would bundle hundreds of these mortgages together into something called mortgage-backed securities. Then they'd sell these securities to pension funds, insurance companies, and other investors around the world. This system broke the fundamental incentive structure of lending. The mortgage broker got paid when the loan was created, not when it was repaid. So they had every incentive to create as many loans as possible, regardless of whether borrowers could actually pay. Lehman got paid when they sold the mortgage-backed securities to investors. So they had every incentive to bundle and sell as many mortgages as possible, regardless of their quality. The investors who bought the securities were told they were safe. AAA-rated investments, backed by American real estate. But here's where it gets darker. Lehman didn't just bundle mortgages and sell them. They kept some of the riskiest pieces for themselves. Why? Because those pieces paid the highest returns. They were essentially betting that housing prices would continue rising forever. And for almost a decade, that bet paid off spectacularly. Between 2000 and 2006, Lehman's real estate-related investments grew from $15 billion to $111 billion. Their stock price increased 500%. Dick Fuld became known as the King of Wall Street. Lehman employees received bonuses that averaged over $300,000 each. The machine was printing money. But the machine was also creating systemic risk that nobody fully understood. Every mortgage that couldn't be repaid, every inflated property value, every misleading credit rating was adding stress to the foundation. And Lehman wasn't just participating in the system. They were helping to engineer it. In 2004, Lehman created something called the Lehman Aggregate Bond Index. This became the benchmark that pension funds and institutional investors used to measure their performance. If you managed a bond fund, your job was to beat the Lehman Index. But the index was heavily weighted toward mortgage-backed securities. So to beat the index, fund managers had to buy more mortgage-backed securities. Lehman was creating demand for their own products. They also pioneered increasingly complex derivatives based on mortgage-backed securities, collateralized debt obligations, synthetic CDOs, credit default swaps. These instruments allowed investors to make leveraged bets on mortgage performance without actually owning any mortgages. The derivatives market grew to over $600 trillion globally. That's 10 times the size of the entire world economy. Here's the critical insight. Lehman wasn't just riding the housing bubble. They were inflating it. Every mortgage they securitized, every derivative they created, every investor they convinced to buy these products was adding fuel to the fire. They were systematically transferring risk from themselves to pension funds, insurance companies, and foreign banks. When the system collapsed, Lehman would face losses. But the real devastation would be felt by teachers' retirement funds, municipal bond portfolios, and European banks that had trusted American credit ratings. By 2007, warning signs were everywhere. Housing prices had stopped rising. Mortgage defaults were increasing. Several mortgage lenders had already failed. But Lehman doubled down. They increased their real estate exposure. They raised their leverage ratio. They convinced themselves and their investors that they were seeing a temporary correction in an otherwise healthy market. Dick Fuld famously said in early 2008 that Lehman had been stress-tested for every possible scenario. They had survived previous crises. They had the best risk management systems on Wall Street. They were, in his words, built to last. He was catastrophically wrong. The stress tests had been designed around historical models that assumed housing prices could never fall nationally. The risk management systems had been calibrated to normal market conditions, not systemic collapse. And the culture of Lehman had become so focused on short-term profits that long-term survival was secondary. The machine that had generated billions in profits was about to reveal its true nature, not a wealth creation system, but a wealth transfer mechanism that had been moving money from the productive economy into the pockets of financial engineers. And when it stopped working, the consequences would reshape global finance forever. The warning signs started flashing red in early 2007, but Lehman's leadership chose to ignore them. Bear Stearns had already collapsed in March 2008, requiring a government-orchestrated bailout. Other investment banks were quietly reducing their real estate exposure, but Dick Fuld and his team made a decision that would seal their fate. They decided to fight back against what they called market manipulation and short seller attacks. Here's what actually happened behind closed doors. In June 2008, Lehman reported a second quarter loss of $2.8 billion, their first loss since going public in 1994. But instead of admitting the severity of their situation, they engaged in what can only be described as financial fraud. They used accounting tricks called repo 105 transactions to temporarily move $50 billion of debt off their balance sheet just before quarterly reporting periods. This made their leverage ratios look safer than they actually were. The Repo 105 scheme worked like this. Days before the end of each quarter, Lehman would sell securities to other financial institutions with an agreement to buy them back after the reporting period ended. Technically, this qualified as a sale under accounting rules, so the securities disappeared from Lehman's balance sheet. The cash from the sale was used to pay down debt, making their leverage ratio appear lower. Then, immediately after filing their quarterly reports, Lehman would buy the securities back, and the debt would reappear. This wasn't creative accounting. This was deliberate deception designed to hide the true extent of their financial deterioration from investors, regulators, and their own shareholders. Ernst & Young, their accounting firm, signed off on these transactions. The Securities and Exchange Commission, which was supposed to be monitoring investment banks, never detected the scheme. The credit rating agencies continued to rate Lehman's debt as investment grade, but the market was starting to see through the illusion. Lehman's stock price, which had peaked at $86 in early 2007, began falling dramatically. By summer 2008, it was trading below $20. Short sellers were betting billions that Lehman would fail. And Dick Fuld was taking it personally. In congressional testimony later, Fuld would claim that Lehman was the victim of a coordinated attack by hedge funds and competitors who spread false rumors to drive down their stock price. He believed that if the government had intervened to stop short selling, Lehman would have survived. This narrative became central to how Lehman's leadership justified their actions. They weren't failing because of their own decisions. They were being destroyed by market manipulation. The reality was far different. By August 2008, Lehman's real estate portfolio had lost over $60 billion in value. Their leverage ratio, when calculated honestly, was approaching 40-1. They needed to raise capital immediately, but no one wanted to invest in a bank that might be insolvent. Foreign sovereign wealth funds, which had been eager buyers of American financial assets, were backing away. Private equity firms were demanding terms that would essentially give them control of the company. Here's where the story becomes a case study in how financial institutions handle existential threats. Instead of admitting their problems and seeking help, Lehman's leadership chose to gamble everything on a single strategy. They would spin off their real estate assets into a separate company called SpinCo, keeping only the profitable investment banking operations. This would allow them to claim that their problems were contained and temporary. The SpinCo plan was brilliant on paper and catastrophic in practice, Creating a separate entity for toxic assets would require months of regulatory approval. It would need massive financing that didn't exist, and it would require investor confidence that had already evaporated. Most importantly, it ignored the fundamental problem. Lehman's entire business model was based on leverage and interconnectedness. You couldn't simply separate the good parts from the bad parts when everything was connected to everything else. While Lehman's executives were designing complex restructuring plans, the firm was hemorrhaging cash. Corporate clients were withdrawing their funds. Trading counterparties were demanding additional collateral. Credit lines were being reduced or canceled entirely. The firm that had survived for 158 years was experiencing a classic bank run, but instead of depositors lining up outside branches, it was happening electronically at the speed of light. Timothy Geithner, then president of the New York Federal Reserve, later described those final weeks as watching a slow-motion car crash. Everyone in the financial system knew Lehman was in trouble. Everyone was preparing for their failure. But everyone was also hoping someone else would solve the problem. The Treasury Department under Hank Paulson was adamant that they would not use taxpayer money to bail out another investment bank after the political backlash from Bear Stearns. This created a deadly game of chicken. Lehman needed a buyer or government bailout to survive. Potential buyers needed government guarantees to take on Lehman's toxic assets. The government refused to provide those guarantees without private sector participation. And time was running out with each passing hour. Bank of America briefly considered acquiring Lehman, but walked away when they realized the extent of the real estate losses. Barclays, the British bank, was interested, but couldn't get regulatory approval from UK authorities fast enough. The Korean Development Bank explored a deal, but demanded terms that would have given them control at a fraction of Lehman's book value. By September 12, 2008, it was clear that no private sector solution existed. Lehman Brothers, the fourth largest investment bank in America, was going to fail. But what happened next revealed something crucial about how modern finance actually works. The failure of one institution, no matter how large, wasn't the real problem. The real problem was what economists call contagion. Lehman wasn't just connected to other banks through loans and deposits. They were connected through a web of derivatives contracts worth trillions of dollars. Every major financial institution in the world had some exposure to Lehman through credit default swaps, interest rate swaps, currency hedges, and other complex instruments. When Lehman filed for bankruptcy, all of those contracts became worthless overnight. This is where the mathematical precision of modern finance met the chaos of human psychology. Algorithms that had been designed to manage risk in normal market conditions began selling everything simultaneously. High-frequency trading systems that relied on statistical relationships between different securities discovered that all correlations had broken down. Risk management models that assumed certain institutions would never fail suddenly had to be recalibrated. The collapse of Lehman Brothers wasn't just the failure of one bank. It was the exposure of a system that had been designed to privatize profits while socializing losses. Dick Fuld walked away with over $500 million in compensation during his tenure. Lehman's executives collected billions in bonuses while building a machine that would cost taxpayers trillions to repair. And here's what should terrify you most. Nothing fundamental has changed. The banks are bigger, the leverage is higher, the derivatives markets have expanded, and the same incentive structures that destroyed Lehman are still operating today. We learned the wrong lessons because the people who caused the crisis were the ones who got to write the rules for preventing the next one. If this opened your eyes to how the financial system actually works, subscribe, because the next crisis isn't a question of if, but when.